Income, when it comes to rental properties, residential rental properties, is key. Net operating income divided by your purchase price creates the cap rate, which is how you evaluate essentially the value of your purchase. This is a key concept. So if you don't understand the income of your property, then you really don't know how much you can finance, what you should pay for it. You just don't understand the risk of the property at all. What we're going to do is I'm going to take you through an income statement as it pertains to residential rental property. We're not going to talk about the whole balance sheet. We're just going to talk about the income statement. And this is a very specific way of looking at rental properties. I'm going to teach you a specific way to look at this. If you don't know accounting, it doesn't matter. Let's start. You start off with revenue. Revenue is literally the rent you charge per unit per month, and then you annualize that. Your monthly rent times 12 per unit, that gives you your income number. That is your gross income. The next thing you would look at is your gross potential income, which also includes other things. Okay, so maybe you're charging extra for laundry. Maybe you're charging extra for parking. So you'd add that. Maybe you're charging extra for utilities. Cable, that's another common one. If you're charging for those things and you have some sort of markup on them, you put it into your additional line item after you've done your rental income. So that would give you your gross potential income. An effective gross income is gross income minus your vacancy rate, essentially. The vacancy rate would be a percentage. Let's say there's always an allowance, because if you have 1 month where you're changing over a unit, so there's at least some drag in terms of vacancy on every financial statement. And the lowest any bank or financial institution would get away with is 2 to 3%. Let's continue. The next thing we would do is take out our operating expenses. And the operating expenses are actually fairly standard. If you're doing a CMHC application, they're standard to the point where they actually put in benchmarks, and I'll go over that a little later in the video. But right now, you've got to look at what are your normal expenses. Property taxes, insurance, heat, hydro, water, repairs and maintenance, salaries of any employees you may have, management fee, replacement reserve allowance, and then other, which could be advertising or legal fees or accounting fees. Once you deduct those expenses, you actually have your net operating income. So the net operating income is the number that you use for all the evaluations. If you're looking at getting debt, they're going to look at your net operating income, and then they're going to look at the debt carry, and then they're going to create a debt coverage ratio. So, I've spoken about this in other videos. The debt coverage ratio is essentially the amount of times the income covers the debt. For apartments or rentals, that's usually 1.2 times. Let's go into a bit more detail. If you were looking at doing a CMHC application, which is actually the best way to finance an income producing property, because you end up with rates that are typically 100, 130 basis points less than a conventional mortgage rate. And it's a great government program in Canada. It makes perfect sense, especially if you plan to hold a property. There's application fees. Generally speaking, if you're planning to hold a property between 5 and 7 years, it pays for itself. It does last for the life of the property. So if you're getting a 25-year amortization, a 30-year amortization, you pay for this once, and it gives you this insurance for the entire life of the loan. If you plan to hold it forever, definitely the best way to go. So let's talk about benchmarks. CMHC, when they look at something like this, they would look at the taxes at the actual rate, the insurance at the actual rate, the utilities at the actual rate of the property. Then, depending on the build form, they would look at, they would use a benchmark of $830 a unit per unit for your maintenance. They're going to use 4.25%. They're going to use salaries, and whether you pay the salaries or not, they're still going to deduct it, and that's $555 a unit. They're also going to look at things like replacement reserve. The benchmarks vary. It could be, $50, $150, depending on what appliances are in place. These benchmarks are published, so you can look them up yourself. So if you want to create a pro forma for yourself for a CMHC application, you can call our office. We'll happily guide you through it. But theoretically, you could look this up yourself. The other costs, like advertising, permits, garbage, snow removal, landscaping, security, they do 1% of effective gross income. That's other. Okay. Everything else is actual costs. Of all the different asset types you can invest in, this one is the most prescribed and formulaic. In a lot of ways, it's the easiest one to evaluate because you just know how everybody's going to look at the debt. So that'll determine, you know, what your income is. And then when you're looking at your income, you look at your ceiling rate or your actual interest rate that you want to underwrite it to. That'll give you, and then you'll calculate your amortization based on that, on, you know, if it's a 20, 25, 30, 35, 40, whatever it is. And that creates your debt coverage ratio. And so you know how much cash you have to put into the deal. From there, you calculate your cash on cash return, and there you go. And you can evaluate that. If you're saying you return 7, 6, 5, whatever percentage it may be, you're on your cash on cash, and if that seems like it's worth it for you to own this property, then you should go for it. In conclusion, understanding net operating income is the key to understanding how to invest in residential rental real estate. Once you understand this concept, you can evaluate and you can start to become an investor in residential real estate.